If you handed me a time machine and dropped me back 15 years ago when I first started investing, I would do one thing differently, and it's probably not what you think. See, what I didn't understand is that wealthy people have an investing playbook, which is a system on how to invest your money to build wealth regardless of what's happening in the markets, whether the economy is booming, going down, crashing, or going sideways. It took me years of trial and error and lots of expensive mistakes to figure it out, but in this video, I'm going to show you how you can build your own investing playbook in 5 steps and hopefully avoid the expensive mistakes I made. And step number 1 is get the money to invest. The first mistake that I was making is I didn't have a plan on how I should allocate my money, and this is something you see across all incomes, that you go to work or you have a business, you make money, and then you go and you spend that money, and then you wonder where all that money went. And now you never have the opportunity to actually build wealth or even worry about investing because all of your money is going out to pay all your bills. And for me, this was dumping my money into my car. I put new rims on my car, put new HID lights on my car, put tints on my car, put new subwoofers on my car, new sound system in my car. And so anytime I was making money, it was going out right here. And then if I had any money left over, that was when I would think about putting it aside to my investments or my savings. But this is where what you want to do is create a system that flips that way now anytime you get paid, the first thing that you do is you put money aside to invest and save, and then you spend what's left. And this is where having a simple system, something like a 75-15-10 plan can be very valuable, which is for every dollar that you earn from here on out, 75 cents is the maximum you're allowed to spend. 15 cents is the minimum you invest. 10 cents is the minimum that you save. Now, if this was me 15 years ago, I don't want to follow this. I want to be a lot more aggressive with my investments, because if you're young, if you're in your teens or if you're in your 20s and you don't have really any expenses, you're not married, you don't got kids, you can be a lot more aggressive with your investments. Yeah, that means you don't get to drive the nice car or go on some fancy vacations. But if you can invest aggressively young, that can set you up for a lifetime of freedom later on. Maybe now you can follow something like 50, 30, 20, which is you're going to live off of half of your income, invest 30%, save 20%. Find what's right for you, but the younger you are, the more aggressive you can be with your investments, the wealthier you will become. And I want you to also create 3 different bank accounts. Have one bank account for your spending money, have one bank account for your investing money, have one bank account for your savings money. The reason why you want separate bank accounts is because psychologically it is so difficult, it's impossible to differentiate the money in your checkings account from your investments to your savings to your spending. And so when you see that sale on the TV on Amazon, it's very easy to accidentally spend your investment money. To avoid that, create 3 different bank accounts. Most banks will allow you to do this for free. If your bank is going to charge you money, get a new bank. And now anytime you get money deposited into your account, create an automatic withdrawal and deposit. That way now money is going into your investment money and your savings money, and now you have them separate. That way you know how much money is supposed to be saved to protect you. You have money to invest to make you wealthy, and this is the money that you are supposed to live off of. Once you have the money to invest, the second step in your investing playbook is to know the goal from your investments. So you're going to work, you're going to your business, and you're making money. Now you have a system on how you actually put money aside to invest. Let's say you're following the 75-15-10 plan. Now you have money to invest, but where and how are you going to invest your money? This is where your goal comes in handy. And everyone's going to say, well, my goal is just to make some more money. Sure, but how do you want to make the money? Do you want to invest for cash flow, or do you want to invest for growth of the value of your money? Start with one that we understand what your goals are. Personally, I love investing for cash flow, because the way cash flow investing works is you're going to put your money into this investment, and then it's going to pay you every month or every 3 months or every year for doing nothing except owning that investment. I like that because, well, when I have the cash flow, it's steady income, and I know that I can work to stack the cash flow. That way I can work to live off of my cash flow. So if my business were to not work anymore, well, I still have the cash flow for my investments to live off of. Some people hate this cash flow because cash flow means now you have to think about taxes. Cash flow means that, well, that value of the investment might not grow as fast. And cash flow means, well, I have to know what to do with that cash when I get it, which really isn't that hard to solve. The reason why I'm telling you this is because my first real investments were investing in real estate after the 2008 financial crisis. And during that time, real estate prices were at rock bottom. Now, I was not a financial genius. I just started investing in real estate because, well, I had enough money to buy real estate because real estate prices were so cheap. So I started investing in real estate, and it was really nice because now I started buying these properties and they were paying me with rent every single month, which was nice. But then everyone starts talking about, well, invest your money into stocks and do these other things. So I started doing that without understanding the difference between growth versus cash flow. And so I just started investing in whatever was hot, hoping that these investments would make money. And some of them did, some of them lost money. But that's when I started to realize, oh, I like cash flow. And if I focused on that goal of cash flow earlier, I would have way more cash flow now instead of just throwing my money into random investments. And so yes, now I have a much more strategic stock market portfolio. Yes, I have my rental properties, but if I had known that years before, I would have invested into stocks very differently to focus on the cash flow first. That way I could get my goal of that more cash flow first. Once you understand your goal of growth versus cash flow, now we can get into the strategy. This is where things really start to get fun, and I want to remind you that for those of you that are investors or want to become investors, I put together a free investing masterclass that will walk you through how I and my team at Briefs Pro research investment opportunities before the crowd and how we use data to dictate where we're going to invest our money. This masterclass is completely free, it's packed with value, and when you join and register for this masterclass, you're also going to get Market Briefs, my newsletter for investors, for free as a bonus just for joining. So if you want to get my investing masterclass, all you have to do is click the link down in the description below to register. So you're working to generate an income, and now you have a system to always have money to invest because you follow something like 75, 15, 10. Now that you have this money to invest, you ask that question of, do you prefer the cash flow or do you prefer the growth first? Once you understand that, the next question is, what is the actual strategy to make that happen? Are you going to be a passive investor? Are you going to outsource investments? Or are you going to be an active investor? Because that's going to dictate how you actually invest your money. And most people never make it this far, but this is where the real success can be made, because now you can build an investing plan based off of your goals. So let's break this down. Passive investing is you are investing your money yourself, but you're going to keep it pretty hands-off. And you could do this in the stock market, you can do this in real estate, but the whole idea is you have the money to invest, you want to do it yourself, but you don't want to pay somebody else to do it, and this can be a great strategy for the right person. So let me show you how to be a passive investor in the stock market and in real estate, because in the stock market, we know that the stock market has grown by around 10% a year on average for the last 100 years. This does not mean that the stock market always goes up. This does not mean that the stock market goes up by 10% every single year. It means on average, despite the economic booms, despite the market crashes, the stock market has averaged 10% a year. Now, the way you can be a passive investor in the stock market is just by owning a piece of the economy. It's not by trying to go out and find the next Amazon or the next Tesla. It's by finding a fund that will give you exposure to the broad American economy, and then you just keep investing your money into it. For example, again, I can't tell you what to invest in. I'm just showing you this as an example. If you wanted to invest in the broad American economy, VTI is an ETF that gives you exposure to the total stock market, meaning this is a fund that will give you exposure to the American stock market, and you can invest in these funds on pretty much any stock brokerage that is out there. But if you want to get a little bit more niche, SPY is a fund, an ETF, that will give you exposure to the S&P 500. That's the 500 largest companies in the stock market. So if you wanted to invest in the American economy, these two funds will give you exposure to the broad American economy. And now if the stock market goes up, well, generally these funds will go up. If the stock market goes down, generally these funds will go down. And we know that over the long term, the stock market has grown by around 10% a year. But the way that you win as a passive investor here is by following a strategy I call ABB. Always be buying. And that means now you need to create a system where every week, or every 2 weeks, or every month, money is going to be automatically invested into your funds. Whether the markets are going up, whether the markets are going down, whether the markets are sideways, whether it's a Democrat in office, whether it's a Republican in office, whatever's happening in the world, you keep buying. And I say this strongly because anytime you see markets go down, or volatility or concerns about the economy, people freak out. And then they ask, should I sell? And then they get panicky. But the way that you win is to be a long-term investor, invest for years, if not decades, and just following ABB into the broad American economy, because we know that recessions happen, we know that market crashes happen, and they will continue to happen. And the only thing you might want to change is buy more, next time that crash happens, because that gives you the opportunity to buy more good assets at a discounted price. To passively invest in real estate is a little bit different. When I say real estate investing, I'm talking about investing in properties, buying physical houses or apartments or office buildings and then renting them out. That is active. But if you want to passively do that, there are funds out there on the internet where you can just invest your money like you would in the stock market, but instead of investing in the stocks on the stock market, you are getting exposure to real estate funds. And now, because of how fast the internet has been growing, there are opportunities for you to just follow something like ABB, where you can invest every week or every few weeks into these funds, and it can be completely passive for you while you're getting exposure to physical real estate. So if that's something you're interested in, you just go into Google and search some of these crowdfunded real estate deals, crowdfunded real estate opportunities, and now you can invest your money into these funds and keep it passive on your end. Option number 2 is to outsource your investments. So in the stock market, that would mean essentially getting yourself a financial advisor, because now what you're doing is you're going to pay this financial advisor generally with something called AUM, assets under management, and they are going to manage your investments for you, hopefully get you better returns, but then they're going to have to take a fee, a cut of your investments. The AUM essentially says for every $100 you invest, how much is the financial advisor you're going to get. Let me show you what this plays out to be. Let's assume that you invest $1,000 a month. You do this for 30 years, and now because you have a good financial advisor, you can get a, let's call it 11% return on your money. That's better than what the stock market has averaged, but now your financial advisor might charge you, let's call it a 1.5% fee. Now we have to take a look at how much money you're going to generate after fees. This will add up to around $1.9 million, which is pretty good. Now, if you invested your money yourself into the stock market and got a 10% average return on your money, well, you would have actually ended up with more, because now you don't have to pay the 1.5% fee. You would have ended up with closer to $2.1, $2.2 million. But the $200,000 to $300,000 difference is what you were paying in fees. And yes, it can be a lot in fees, even though it's a small 1.5% fee, because that 1.5% fee is going to compound along with your investments. But if your advisor can get you better returns, well, then that fee can definitely be worth it. So this is a great option for some people. You just have to understand how the fees work and make sure that the advisor that you're working with is aligned with your goals. You can also outsource your investments into real estate. This is often called syndicate real estate deals, where now you're going to find a real estate developer, you're going to find a real estate investor who is looking for money for their next real estate deal, and you're going to cut them a check, and now you have a piece of ownership in this property. You don't have to do any of the work. They're the ones that are managing the deal, they're the ones that are managing the money, and now you just sit back and hopefully they're gonna make money and give you a return on your investment. Again, this can be a great option for some people that want exposure to real estate but don't want to actually have to do the work. But you have to go out and find those people. It's not as easy as it is working with a financial advisor, but certain financial advisors might even be able to connect you with those types of real estate deals. Otherwise, you can go to a real estate investor conference. There's always investors and always developers that are looking for money. Then option number 3 is to be an active investor. And this is what most people think about when you say be an investor. So in the stock market, this means now trying to find a company that you believe in for the next 5, 10, 20, 30 years. But the whole way that you succeed here is not just to invest based off of what you see on the headlines, because the mistake that so many people make is they hear about a stock on CNBC or Reddit or Yahoo Finance, and then they invest in that stock because it's on the news. But the reality is, by the time it's on the news, the real money has already been made. So you want to understand, if you really want to make money, how can you find those investment opportunities before it's on the headlines? And that's where your research, that's where your data comes into play, because your research and your data is going to help you understand those investment opportunities and help you find those investment opportunities before everybody else. Now, this is more risky for more potential returns. But if you can get slightly better returns, it can add up to hundreds of thousands, if not millions of dollars of more wealth over the course of your investing career. Because if you can get just a few more percent a year on your portfolio, the few more percent can compound year after year after year to give you more wealth. Again, is it guaranteed? No, absolutely not. Investing is risky, but the way that you can lower your risk now as an active investor is by investing in your own research. Because if you can find those opportunities, you're doing the research to understand where money is moving, that can help you understand why you're making that investing decision. Because a lot of people are investing their money because a lot of people are talking about it on Reddit. But when you invest based off of all that public information, you're doing what everybody else is doing. And when you do what everybody else is doing, how do you expect to get better returns than everybody else? And that's why I want you to start thinking like an investor and understand if you want to be an active investor in the stock market, this is all about what is your research. This is what I talk about in my masterclass on how do you actually do that research and how our firm does that research. Again, if you want to register for that masterclass, the link is for you down in the description. And with real estate, well, it's a little bit different. With real estate, now you're not investing in stocks. You're going to actually go out and find those properties. You're going to go out and buy the rental properties, whether it's a single family house, an apartment complex, an office building, a storage unit, or whatever type of property it is. And you're going to rent it out to other people. This can be a great way to invest your money, but it's going to take more work. It's going to take more time. It's going to take more effort, but you also get better tax breaks. And you can also get the returns for yourself. So it just depends on how involved you want to be for investments. What I learned very on is I like this active side of investing. That was interesting for me. I also like this passive side of investing as protection against my own mistakes that I make as an active investor. So for me, I became an active investor first, then I added on this passive investing to help layer on top of that. But you have to know what's right for you, because the mistake I see so many people make is they say, I want to be a long-term investor. So now you start investing in random companies you see on the internet, and then as soon as the stock starts to go down, well, now you sell and you turn from being an active investor into a trader, and that kind of flips the whole script. Or you say, I want to be a passive investor, and you invest your money into the S&P 500, and then markets go down and now you turn into a trader and you say, you know what, I want to invest in these random companies. So you got to know your strategy. If you want to invest as a passive investor, great. Understand ABB. If you want to work with a financial advisor, you want to work with a developer, you want to work with a way where you just are hands off, great. Then follow that strategy. If you want to be an active investor, great. Invest in your own research. Understand it's more time, more work, more effort, and more risk for more potential return. Once you have the strategy, now it's time for you to, number 4, build your portfolio. So in this playbook, you finally have a system to understand how you're going to put money aside to invest. When you have the money to put aside to invest, now you're going to ask yourself, would you rather prefer to have that growth first or the cash flow first? Once you understand whether it's the growth or the cash flow, now you need a strategy that's going to meet those goals. That strategy could be passively investing your money. It could be outsourcing how you invest that money with a financial advisor or investing into other people's real estate deals, or it could be being an active investor and actually doing it yourself. Once you understand your strategy, now you need to understand where you're going to actually invest your money. And the first thing I would say is invest in one asset class first and learn to dominate that first. But as you start to do that, now you're going to want to start diversifying. And when most people say diversify, they're thinking, well, I'm going to invest my money into a blue chip stock. Maybe I'm going to invest my money into a growth stock, maybe an international stock or a fund, and now I'm diversified. But when I talk about building my portfolio and having real diversification, I want to own different types of assets in different asset classes. I'll show you. Again, I don't recommend what I do to anybody else. And investing is risky, and I'm not a financial advisor, but I'll show you what I do. When it comes to my portfolio design, I invest my money in 5 places in this order. My number 1 largest investment is my own business. That's Briefs Media. Number 2, the second largest investment is into physical real estate. Again, why physical real estate? Because the real estate gives me the active ability to generate the cash flow. Number 3, the third largest place where I invest my money is into stocks. Again, why stocks? Well, because stocks give me the ability to invest actively and invest passively, primarily for cash flow, but I also have some growth investments there as well. Investment number 4 that I have is in speculative investments. This is more now on the growth side. Again, it's more active for me, but this is a smaller piece of my portfolio. These speculative investments for me are, number 1, the startups that I invest in, and number 2, the cryptocurrency that I invest in. But this is a small piece of my portfolio because I understand that, well, all of this could fail. I've invested in multiple startups that have gone to complete zero, bankrupt, and no longer exist. All that money has disappeared. Cryptocurrencies, I understand, can go down to zero, and it's not going to affect me. So I treat these speculative investments like speculative in my portfolio, because if the speculative part of my portfolio goes down to zero, I will be okay. The bulk of my portfolio is cash flow generating because that's what I like, and I also have a little bit of growth here as well, but I know that I prefer cash flow. And then number 5 is physical gold. This is about 2% of my portfolio. This is the smallest piece here. I don't like to think of gold like an investment because it's not actually working to produce any value. I look at that gold as a way to save hard money because it's a physical representation of money. I mean, it's a representation of that effort and labor and time to mine and produce that physical gold. But for me, it's that doomsday protection, that insurance against a downturn, against inflation, against a depression. That's why that physical gold is there. Now, I don't want you to copy my investing strategy. I want you to understand my thinking process, because my goal was to start with one thing first. And so I was making money from my business, and then I started investing in real estate. Once I started to get good at that, that's when I started diversifying and I started putting money here. Then I started putting money here and putting money here. So you can't go out and start doing everything. Start with one, get good at that, and then you can start to diversify into a different asset class after that, and you can build your portfolio the way that best fits your needs based off of everything we talked about here. And this brings me to number 5, which is your selling strategy as an investor. Your selling strategy is going to depend on what your goal is. Because my goal is primarily cash flow, I don't like selling. At least I don't like selling the assets that are paying me with cash flow. I don't personally mind selling some of my growth investments, especially if they're more speculative, if it can produce even more cash flow, because I can live off of the cash flow and it gives me money in my pocket today, and that's what fits my investing portfolio. You gotta do what's right for you. And this is where, for me, I'm not a huge fan of selling, unless it is more growth or more speculative after seeing a big gain. That way I can get more of this, because that's what my investing strategy is. So you got to find what's right for you. And I just want you to think about taxes when it comes time for you to sell as well, because when you sell an investment, you have to pay taxes on that. Now, those taxes can vary depending on where and how you're investing your money. Like if I invested $100 in the stock market today, and then 5 years later, that $100 grew to $500, that $400 of profit is taxable that I have to pay taxes on. Now, yes, your investment income has lower taxes than if I made that money from my job, but there are certain tax breaks that you also get when you invest your money into something like real estate. Because if I invest my money into real estate and I'm getting that cash flow year after year after year, I told you a little bit earlier, the real estate allows you to make money from your rental income and then file tax breaks on that income, so you qualify for lower taxes. But the other thing that you get is, let's say I bought a property for $100,000 today, 5 years later I sell it for $500,000. I can sell that property, make that $400,000 of profit, and dump all $500,000 into a bigger property, paying with more cash flow, and pay $0 in taxes today, thanks to a tax break in the IRS tax code called the 1031 exchange, which says real estate investors can own a property for longer than a year, sell it for a big profit, and not pay any taxes, assuming that they go out and buy another piece of property. But you have to make sure you work with a professional when you do that, because there's a lot of nuances. However, the reason why I'm telling you this is you got to understand your goals, and you have to understand how taxes work. So as you start to grow your wealth, get yourself a good advisor to help you with the process. That way you can invest your money and keep most of the gains for yourself, instead of just giving it to the government in the form of taxes. That's where your tax strategy comes into play. And when you understand that, it can help you compound your wealth even further. This is the playbook that I wish somebody would have walked me through. I hope you got value out of this. But the way it works is, number one, you have to understand how are you going to create a system for your money so you always have money to invest. Because what every wealthy person is doing is they're putting money aside to invest before they spend all of the money. Once you have the money to invest, the second thing you need to understand is, what is your goal right now with your investments? Is it going to be for growth? Is it going to be for cash flow? Once you understand that goal, now you need to figure out an investing strategy that aligns with that goal. Do you want to be more of a passive investor where it's more hands-off? Do you want to be completely hands-off by outsourcing it to an advisor or to a developer or to somebody else who's going to manage your money for you? Or do you want to be an active investor and be more involved with your investments? For me, I like active investing. I like the passive investing. This brings me then to number 4, which is the portfolio design. Again, you want to start with one and then move on to the next. But for me, the portfolio design is understanding that I'm going to invest in my own business, real estate, stocks, speculative, and then gold. And then number 5, understanding your selling strategy. Because whether you're a growth investor or a cash flow investor, you need to think about that. But your selling strategy is going to change depending on if you're a cash flow investor or growth investor. And of course, if your investment is about to go bankrupt, you definitely want to consider selling. But we're talking about when times are good, you want to also understand how that sale can impact your taxes. Again, if you got value out of this video, the best thank you is to share this video with a friend, a coworker, or fellow investor. Now, I know there's a lot of content on the internet about creating passive income, but 98% of what you see is garbage. If you want to have enough income coming from your investments to fund your lifestyle, it is not going to be easy, and it's not risk-free. Investing has risks, but it is possible. So now, if you're still sticking with me, let me show you how you can actually do it.